Five.
Welcome to the Artisan Podcast, where we share insights from the world's leading investors and strategists. Today, you're in for a real treat. We have Marko Papic, strategist for the Clocktower Group out of Santa Monica, California. Enjoy. Marko is a regular guest on CNBC, published author, advisor to many of North America's leading pensions, and one of the most profound and insightful thinkers I've ever known. Marko, welcome.
Thank you, Joe.
So let's, yeah. So let's get down to brass tacks. Marko, tell us, what are the three major geopolitical risks that could change everything?
Well, I think definitely the number one risk is any sort of a conflict between the US and China. I don't think you need me on your show to talk about that. I think everybody is pretty much aware of that at this point. I think that's definitely something that should be number one on everyone's mind. And I think it is. And that's why we probably don't have to talk about it that much because it already is on everybody's mind. I think the second issue is that I think maybe we have spent too much time thinking about US and China. What I mean by that is while measurably and quantitatively, yes, definitely if US and China got into some sort of a military crisis, that would be the most market relevant risk out there. I do think that we have taken our eye off the ball. And what I mean by that is that the domestic political risks are bubbling in both the US and China. And in fact, I find it quite kind of interesting that what's happening in China right now with the regulatory crackdown on the TMT sector. As an example, we saw them, ban like playing computer games for more than 3 hours yesterday. This crackdown continues. It's really wreathed in this rhetoric of fighting income inequality. But that's the same rhetoric that follows the Biden administration and many of its policies. And that's because I think fundamentally both Chinese and American policymakers are in a very similar predicament when it comes to the extremes in their own socio-political experiment, which is that income inequality has become the number one risk to the two countries. And so some sort of a domestic political crisis, I think, would be the second risk. And then the third risk is that we get dragged back into this world of democracy being retrenched. And so that's something that also I think a lot of people don't really focus on. But you have very large economies that a lot of, my clients, my LPs, my investors, myself are invested in. You have countries like Turkey, India, Brazil. They may slide backwards from democracy, from this sort of approach to governance that is more inclusive and towards some form of a dictatorship. And I don't mean like Erdogan is a dictator, not at all. I mean like straight up coup d'etat that like topple democratic governments. That's something we haven't seen in a while, but I think that it may be back in vogue over the next 5 years.
So let's tie together, two of the second points. And a lot of times the millennials are criticized as being nothing against you, Fabian, as being snowflakes and not being able to take criticism and difficult times. Whereas the previous generations had been through wars and the Depression, and so if there was some difficulty, at work or in society, then they could handle it and work through it, And so if we take a step back and look most recently, at the pandemic, the economic shock was big, but it was extremely short-lived. Governments felt that they needed to have a massive response in terms of fiscal and monetary. In fact, if you compare it to the previous crisis, which was the worst in 70 or 80 years, the fiscal response was even larger, and the monetary was similar. So if we look at that, how do you see things, playing out from that perspective in terms of the response of the various monetary authorities and fiscal authorities?
Okay, so I'm going to share a screen with you if that's okay.
Sure.
because that's exactly one of the charts that I've brought today. So as you can see here, and I hope everyone can see it. I don't want to blow it up necessarily because I do want to have this panel on the left. But
Sure.
what you can see here is that on the left side is your fiscal stimulus story. The 2020 COVID recession produced more fiscal stimulus than the past, not just the last recession, but the last 1, 2, 3, 4, 5 recessions combined. So the increase in the budget deficit amidst this last recession was 5 times greater, more, 6 times greater. And in terms of the increase in Fed holdings of US Treasuries, it was similar. The 10 years under Bernanke and Yellen produced an expansion of 1.7 trillion, and then 4 months during COVID recession produced 1.8. I think most investors believe that this is COVID related, that the reason that policymakers were so aggressive this time around is because we were fighting a pandemic. Everybody can get behind stimulus, partisan squabbles fall aside when there's threat to Americans and so on. I disagree. I think that, of course, the virus had a role to play in motivating policymakers to do this, but I think that actually what motivated policymakers to spend as much money as they did and print as much debt as they did, what motivated them were the events of the past 10 years. And in particular, populist surprises like Brexit, like the election of Donald Trump in November 2016. There is a sort of acquired knowledge that politicians in the US and around the world, but particularly in the US, have acquired from the last 10 years. And that acquired knowledge is that, well, to put it bluntly, Joe, that people are pissed. That there's this agita, this angst, ennui, that the median American voter feels. And so I don't really care what kind of a recession we had. Honestly, we could have had a shallow recession. And my view was that we would have had an unnecessarily large fiscal and monetary response, even if it was just a shallow recession. Now, obviously, it wouldn't have been this big because the hole in the economy wouldn't have been as big, but it would have been unnecessarily large. Now, to your point about millennials, though, I would disagree because I am also the oldest of the millennials. To defend Fabian here a little bit, I will say one thing. This ennui that you have in the median American voter, first of all, I think is intergenerational, but yes, it may be most felt in the Gen Z and the millennials. But let me point out something very important, which is kind of my North Star, my guiding star for the cycle. This is a chart that shows you the top 10% income share of total income of 3 countries. So how much of the total GDP accrues to the top 10%, basically. And what's fascinating about this chart is not the end point, because we all know what the end point looks like. The US is on top, 45% of GDP in the US, actually higher than that. It's about 47% of US GDP goes to the top 10% of the population. UK is somewhere in the middle, and there's, quote unquote, socialist France at the bottom. But what's interesting to me, Joe, is that this wasn't always the case. In fact, in 50s and 60s, France had a slightly higher share accruing to the top 10% than the US did. And then over the course of 60s, but particularly 70s, the French underwent a socio-political experiment to change this. This socio-political experiment was a product of the 1968 revolution, which was a revolution primarily by the workers and the baby boomers. And just to be clear, in 1968, baby boomers were, the millennials of the age. They hadn't experienced the war. They were born into massive prosperity. Their parents were the ones that had suffered, but they basically went to Woodstock and got high. And then they went to college and they were like, oh, life here is unequal. Let's burn down Paris. Obviously I'm paraphrasing. But my point is that the subsequent 10 years of French history saw, and that's why I circled it, this incredible effort to redistribute wealth. And what's important for your listeners to understand is that when did socialists actually take over France? When did a socialist president actually get elected? It was right here, at the end of this process.
Okay.
And that's important because what that tells you is that it doesn't matter what party is in power. It doesn't matter if Biden or Trudeau or whoever. I don't really care. I couldn't care less. What matters for policy and what matters for investors is where is the median voter. My point with this chart is that the median voter of America is exactly where the median voter of France was in 1968. We had a revolt and a revolution in America in 2020, both during the summer, the social justice protests, and January 6th, the storming of Congress. Politicians in the US, I think, are going to continue to strive or err on the side of left-wing redistribution and of stimulus, whether Biden's in power or someone else.
Yeah, I think that is the exact point that I was trying to make, that in a certain sense, we are all millennials now. And there isn't that much difference between, the left and the right. If we look at the 1970s, there was a very clear left. And then we had the creation of the right in the 1980s, in contrast to that. And by the 1990s, both sides were kind of similar. And in a certain sense, now we are all socialists. Whether it's left or right, there needs to be, large government spending and fiscal excesses. So I guess the question is, if both sides are in agreement with that, and if that's what a society is demanding, what's the end point? Trees, don't grow through the sky. Like, how does this complete itself?
Well, I think, first of all, I don't know if we need more redistribution. I just try to forecast kind of where we're headed.
Sure.
I know we're headed towards it. I think like every pendulum ultimately, swings too far. And I think that, and by the way, for those of you who don't know this, I don't think you mentioned this. You led off the introduction of me, Joe, by saying I'm on CNBC, which I think probably knocks me down a few pegs in most sophisticated listeners. I think you should have led with the fact that you and I worked for a very long time together. And I remember when I started working at BCA Research in 2011, you took me out for coffee and you told me about, the pendulum, and you were 100% right. I mean, at the time, your point was, look, the pendulum is going to swing to the left. And it's going to swing to the left very, very dramatically over the next, decade. And I think you've been proven really correct. I remember this conversation as it was yesterday. And I think that it's going to end with inefficiencies for sure. Okay. I think it's going to end in the US case, and this is an important point. A lot of people have the view that you and I share here. Everyone's socialist now. A lot of people have this view. Bridgewater has been writing about this, for example. The largest hedge funds in the world, Ray Dalio has been talking about populism for a long time. So it's not like we're breaking new ground today on the podcast, on the webinar. But what I would say is that my view is nuanced, because what I'm saying, Joe, is that this is happening in America at a much higher degree than anywhere else. That's what I would argue. I would argue that, yes, there is ennui, there's agita, there's this malaise in every single society, but it is actually by considerable degrees, the highest in the US. And so you will see the US swing the furthest to the left relative to where it's starting. So I'm not saying that America is going to become Sweden in the next 4 years. I'm saying that from where it is starting in terms of where it is on the socio-political spectrum of how it has designed its economy and the redistribution system, I think that the US will move most dramatically. I don't think the markets are prepared for this. And the reason I say that is for two reasons. The dollar is actually holding up quite well. And the 10-year yield is still very well bid. And I think that when you think of the scale of fiscal stimulus that we've already had, and that I think is still coming, I think that I'm not sure that that it makes really sense that the US dollar holds up as much as it has. The other issue is that I think that monetary policy is very interesting. I think that Jay Powell is trying his best to maintain an orthodox central bank. I think the June FOMC statement certainly kind of broke this conception that the Fed is going to be massively behind the curve. And I think that at some point over the next 12 months, he's going to be forced to backtrack his orthodoxy. In other words, I think that the median voter is not really ready for orthodox monetary policy, is not ready for normalization, and neither is the Biden administration. And so I think the pressures on the monetary policy will also pick up over the next 12 months, and you will see policymakers on both fiscal and monetary side constantly kind of revert back to unorthodoxy and towards easing. Now, let me give you just one chart before we go anywhere further. Is this priced in? Do investors believe this? I would say no.
Okay.
I would say that most investors have lost, like the median investor has lost the enthusiasm for this populism trade. And you can see this here on the right side. On the right-hand side is a chart that, so the yellow line is the cumulative revision to budget balance. So this is expectation of where the budget balance is going to go. And what you can see is here in January, with the Georgia election and the subsequent passage of $1.9 trillion of kind of unnecessary spending, you see the revisions go up, so we're going to have more budget deficit. And then in March, there's this loss of expectation of more fiscal policy. In fact, the revisions are not coming down. There's this expectation that budget deficit in the US will go down. Like they're not going to spend anymore. You can see that the 10-year reacted very similarly to that. The 10-year basically peaked, the yield, also in March, where this like fiscal response was exhausted. Now, there's other reasons that the 10-year has gone down. I'm not saying this is one-to-one correlation. You know this. We've both worked at BCA Research. We know how to manipulate a chart. My point is, though, it does matter. And I think there's been this loss of confidence in American policymakers to be socialists. It's like, they're not really going to do that. They're not going to spend any more money. It's complicated. Congress is complicated. It's like, no, it's not complicated. Biden still has 50-seat majority in the Senate. He's going to ram that $3.5 trillion reconciliation package through Congress one way or another. His need to do so has been increased by the failures in Afghanistan. He has to show some success somewhere. They're going to pass $3.5 trillion. They're going to pass the $800 billion infrastructure plan, and then another $250 billion in the Endless Frontier Act. And I really compare what's happening today to what happened in 2017. I was writing about this at BCA Research. Same chart on the left-hand side. But 2016-17, you see President Trump gets elected in November. The yellow line goes up. Expectations, deficit is increase. We've got a populist in the White House. Doesn't care about budget deficits. And then over the summer of 2017, again, over the summer, people lose confidence in the ability of Trump administration to really blow out the deficit. And then he gets all his ducks in a row and passes that unnecessary pro-cyclical fiscal stimulus at the end of 2017, the tax cut. The 10-year reacted the same way. So I would say that there's this loss of confidence right now in the populism team. That's a loss of confidence in the ability of politicians in the US to actually spend more money. And there's this view that the Fed is somehow going to be orthodox for the rest of the cycle. I think both of those are going to be proven incorrect at some point over the course of the next 12 months.
So would it be safe in terms of the US to say we should be betting on additional fiscal stimulus from here? And, we saw Powell say we're going to move towards tapering by year end, but that, rate increases will be slower than the market expects. Would that be kind of bottom line for the US?
We'll see, Joe. It depends on what you think.
Okay.
And what I mean by this is if you think that tapering is going to cause, any impact on the economy, then you're going to have to delay it. And so I think that's to me, the issue is this. They're going to stay behind the curve.
Okay, very good. Mm-hmm.
That's how we should conceptualize, I think, where we're headed.
Okay.
I think what's very important is when they stop tapering. Right now, from what I understand, and I'm not an expert in monetary policy, but the hawks and the Fed wanted to end in middle of 2022 so that they can have the luxury of raising rates basically by the beginning of Q2, like beginning to the end of Q2. And if you look at the Euro-dollar futures, you can see that there is an expectation now of basically 2 rate hikes by March of 2023. So there's this expectation that we're going to start raising rates at the end of 2022, beginning of 2023. And the only thing I will say to that, again, I'm not an expert in monetary policy, but I am an expert in politics. And here's what I say. Like, we're going to raise rates in 2023? Okay, that's a cool story. We've never done that.
Okay.
Like, this is a chart basically of how many rate hikes there are before an election. And the average number of rate hikes 18 months before election is like 20 basis points. So I'm supposed to believe that in the middle of this new paradigm where the median American is concerned about income inequality, not your clients, but the median American, the Fed is going to be hawkish 18 months before the election. Like, okay, maybe, but I wouldn't bet on it. So I think they're going to remain behind the curve while inflation continues to surprise to the upside, which I would expect it to continue. And so what do we do with that? Like you tell me, Joe, if they're behind the curve, inflation expectations go up, inflation surprise to the upside, what's the investment implication of that?
Well, I think the argument would be to fade the Fed and to bet bearish US dollar, which sounds like how you're positioned.
That would be my bet too, but that bet hasn't really worked out, and that's what's interesting to me. It hasn't really been working out for most of this year, and I think if you look at positioning right now, it's actually fascinating. So the reflation trade, I talk to hedge funds a lot. That's part of my job. It's just to continue to nurture our network of really brilliant macro managers and to seed new ones. So that's part of the thing that we do here, and it's so interesting. Everybody just had so much clarity in Q1 of 2021. Everybody was aligned in position to the reflation trade, which is really long commodities, both vanilla stuff like oil, but also coffee, long EMFX, short US dollar, long cyclicals, short growth stuff. And everybody was aligned. The entire macro hedge fund community had all of this in Q1. And then March was the first hiccup with the 10-year peaking, and then of course June FOMC caught a lot of people offside. So I'm with you. That's a clear investment implication, but it hasn't worked. And I think the reason it hasn't worked is because we as an epistemic community, like the financial community, are still wedded to the last paradigm. And so people bring up these concerns like, what about household deleveraging? What about secular stagnation? What about, where am I supposed to invest if not the FANGs? Like all of these things weigh heavily on us as a community. And I would argue that the reason they weigh on us so heavily is that if you are still investing today, if you're still an investor today, if you're alive in this brutal industry, it's because you got the last 10 years right. Because you cut your teeth and because you were you were long bonds on every increase in yields, because you were long up to here FANGs and nothing else. And because you held your nose and moved away from emerging markets in Europe and said that's all crap, that's why you still have a job in the financial industry, because you got those calls right. And I think that it's difficult for us as a professional community to then say like, oh, well, it's different now, because populism. And so you see this like hesitancy to really move with where I think politics are headed.
Okay, so let's change tack a little bit and get down to kind of a big value issue and a big investor question that we've been kind of internally arguing about and having discussions with our clients. And so the idea was to be pretty negative on emerging markets and China for much of the past decade, but that you should be moving into a more positive view, but it's too early right now to make that shift. So from a market's point of view, you look last year, China was one of the best performing markets in the world. EM outperformed. This year, disaster. The worst performing market in the world. It's, 5 sigma oversold. So maybe let's just start off with what's going on in China.
Well, I think, first of all, we have a business in China, by the way, so we have a lot of on-the-ground research that comes out of there. And that was a decision we made in 2014. We set up an office in Shanghai, and our expertise is illiquid alternatives. So what we do is we map out the manager space in China, basically the hedge fund manager space. I put quotes because you can't really be a hedge fund, although the rules are changing. And so early this year, and really late last year, we had a clear view that what China was doing was deleveraging. They basically said, look, COVID is done. We solved it. We're awesome. They did that by the end of Q1 of last year. They became the, they're already factory of the world, and they just were on steroids because we were just sitting at home pressing Amazon. So Chinese economy recovered very briskly, and it was really export-led. So Chinese policymakers felt that they didn't really need to do anything in terms of supporting the economy. They normalized both fiscal and monetary policy very quickly in 2020. And they went into 2021 basically flagging that they wouldn't adjust any of their policy, that they would actually continue to be quite hawkish. This was the irony, the Chinese policymakers learned a different lesson from American policymakers. American policymakers learned the lesson they didn't stimulate enough. After 2008, 2009, the Chinese learned the lesson that they stimulated too much. Now that was unsustainable. And almost our entire network in China started talking about income inequality around February and March of this year. You could hear it from the grapevine. Hedge fund managers were talking about it, policymakers were talking about it, journalists were talking about it. There were a lot of examples of households really starting to hurt. And that's because China provided no support for households at all. So households' income in China collapsed the way they're supposed to in a recession. Ours went through the roof, which is the first time in human history that you've had a recession where incomes are like going through the roofs. And so in China, the pain of this recession has really been felt, particularly for those who don't work in the export-oriented industry, which of course went up. And so my point here is just to say that the reason to be short China in 2021 has nothing to do with the regulatory crackdown. It's that policymakers entered this year already on a very hawkish footing. So they were already set on a hawkish footing. Now, what then happened is that Xi Jinping needs to win an election 12 months from now. Now, a lot of people in the West think that China's already become a Maoist dictatorship, that there is no sort of like political contest in the Chinese Communist Party. There is. He's not a shoo-in yet. He needs to stabilize the economy, and he has to have a narrative that makes him, like the obvious choice. And that narrative is, oh, look, they woke up to this reality that income inequality in China is extreme. And so he has steered policy towards that. And that means two things. One, it means China is moving away from deleveraging. So from a macro perspective, this is really important because when we talk about, this reflation trade ebbing, when we talk about like commodities, like not appreciating after March, after April, May, when we talk about the 10-year peaking, one of the reasons that's happened is that China had a policy setting too tight. Right. They're now easing on that front. But the other issue that I think is also interesting is that China has now convinced itself that the Americans fooled them, that the Silicon Valley model of development doesn't work for them. So this isn't just about like policy setting on interest rates or fiscal. It also has to do with what developmental model are we going to adopt. And what Xi Jinping is arguing, and I think this is permanent, and I think this will matter for sectoral selection in China. What Xi Jinping is arguing is that, look, Silicon Valley model of growth is not appropriate for China. We shouldn't have our employment as our percent of employment in manufacturing drop below 19% where it is today. That's a path to even greater income inequality. We don't want to become in America, and we don't need a cheeseburger delivered at 3 a.m. That's not a sign of a sophisticated, advanced economy. We need hard tech. Okay. And this is something the Chinese policymakers have been guiding since 2018, 2019, but they're now really accelerating. What they're basically telling us, Joe, is that they want to be Germany, they want to be Japan, they don't want to be America. And so I think that the regulatory setting in China is going to continue to be to steer investors towards sort of hard tech sectors. What does this all mean? I think it means that when you think about policy setting plus regulatory setting, I think the worst part is done in China. I think policymakers are going to ease policy, not as much as they have done in the past, so don't expect huge infrastructure spending, but they're definitely going to cut interest rates. We think not just RRR, we actually think real interest rate, like their main policy interest rate is going to be cut. So that's the first issue, which is good for stock markets. But the other issue is we think that the Chinese Communist Party is giving you as the investor sectoral allocation. They're telling you, invest in these sectors, don't invest in these. It's like the easiest place in the world to basically invest because the government has said what they favor. And I think that that's going to be the next story of China. And you can already see this, by the way. I just want to show you this chart. So basically, what sectors am I talking about? So when they say hard tech, they really mean anything that has to do with green technologies. We've even heard rumors that they're going to do a green interest rate cut, which will basically favor banks that lend to EV, battery, solar companies. You can see what's happened to solar companies in terms of against the A-share benchmark. Since the regulatory crackdown, they've basically gone through the roof. Same with semiconductors. Anything that has to do with this kind of a hard tech space is probably going to go much higher.
Okay, so if we, strictly from a market's point of view, for China, there's kind of two questions. There's the internal question and the external question. So
yeah,
let's, for a moment, just focus on the external question. Usually the economy is bottomed 6 to 9 months after social financing or liquidity growth. That's very important for the Canadian investors because Chinese growth is very tied to commodities. Commodities very tied to the Canadian dollar, to the Canadian stock market. So have we basically seen the trough in terms of reflation, and we'll see accelerating reflation from here? So for those more traditional reflation bets, should we be starting to allocate money now?
I mean, if you have the cojones for it, yes.
We've got I don't know about the cojones. We have a long time horizon.
Well, yes, then if you have a long time horizon, I think it's fine. I mean, I was going to say, why not wait for a month or two to see what happens on the U.S. side.
Okay.
I think it's going to take a month or two for the U.S. side of equation to be resolved. And I think the U.S. side of equation is important.
Okay.
And let me say what I mean. I don't think I have a chart on this here, but I'll just describe it.
Sure.
You were talking about total social financing in China. So if you advance total social financing by 6 months,
yeah,
it has a perfect correlation with the 10-year yield up until August of 2017. And then it gets wacky. There's still some correlation, but it gets wacky. Now, this is kind of a nerd talk here between two former sell-side chart guys. But just hear me out, because this is important.
Okay.
TSF used to lead the U.S. Treasury yield 1-to-1. I used to joke, if you left me on a deserted island, and for some reason you gave me Bloomberg terminal with a connection, but only one indicator with which to build my asset allocation, I would have asked for TSF.
Sure, yeah.
And that was because in the last cycle of household deleveraging in America, of malaise, of ennui, of secular stagnation, the only game in town was China and Chinese credit. Okay, we all know that.
Okay.
But that diverged, Joe, in August of 2017 because that was when the United States of America confirmed that it was no longer in the Washington consensus. It's when the United States of America confirmed that it was going to do pro-cyclical, unnecessary, end-of-cycle fiscal stimulus. And that was when investors realized that, yes, President Trump will get the Tea Party to blow out the budget deficit unnecessarily for no good reason. And we've been in that paradigm, I think, ever since, not because of Trump or Biden, but because the median American voter is basically pissed and wants nominal GDP growth. So what I'm getting at here is that I think that we cannot basically gauge performance of commodities or the Canadian dollar or the US dollar anymore purely with TSF, because TSF has been tanking for much of this year, but commodities actually held up quite well.
Okay.
And even copper, which of course fell, it kind of rebounded as well. And that was a good example to me of how, Chinese TSF is no longer the only game in town. It's very relevant. The other issue that's interesting is that Chinese imports, so China importing goods, have also held up fairly well. Now they've rolled over, as all things have rolled over, but Chinese imports have held up even though TSF has collapsed. That chart is another alligator jaws chart, and we have a lot of those, by the way, in this new paradigm. A lot of things are not kind of correlations are not sticking. That's an interesting one. Why are Chinese corporates basically importing goods when TSF is going down? And my view is that they have basically gorged themselves on our dollars over the last 18 months, and they're buying imports, especially intermediate goods, for export off of their balance sheet, not on credit. And that's because, of course, the Chinese economy basically was recapitalized by a surge of demand for what they produce. So, in other words, I think that TSF is going to start normalizing. I think it's not going to continue declining. But even the decline itself has not produced the kind of dollar rally and commodity collapse it would have in the past.
Okay. So basically, from a forward-looking perspective, China is bottoming, but the rest of the world, including the US, may slow. Does that mean you should be favoring emerging market stocks over US stocks?
Well, I thought that since COVID started, that was my number one view. As you said, it worked last year, didn't work out this year.
Yeah.
And so, yeah,
I'm the exact same.
Yeah, no, listen, I think definitely emerging market stocks are going to do well. We actually we have a bunch of illiquid alternative businesses, and we launched. I mean, this is. I mean, we're putting our money where our kind of macro mouth is. We launched the Latin America FinTech Fund this year because of this macro view. In part, it was the easiest fund to raise money for in the history of our firm. So earlier this year, we raised money for this fund, and it went by so quickly. And I think that a lot of investors have this view. And the problem, though, is that the positioning for reflation trades was at historic highs earlier this year. We're having this washout right now. I would maintain my view that for the next, X amount of, 12, 24 months, 36-month horizon, I do think emerging markets are still a good buy. Valuations are there. Okay. Current accounts are in a surplus. Currencies are cheap. So yeah.
But just be careful with some of the broader relationships that used to work in the past. They might not be working now because the U.S. has changed. We are seeing some questions come in from our viewers, and in particular, about the MiddleEast. You had said quite some time ago that the U.S. Was pivoting away from the Middle East, towards Asia, and now we're starting to see some issues in the Middle East with Afghanistan and so on. How do you see things playing out? Let's say over the next year or two in the Middle East?
Well, I think that what's been happening in the Middle East has been there's been a continuation pretty much of policy from Obama to Trump to Biden in terms of Afghanistan. The U.S. has really no interest anymore in sinking resources into Afghanistan. And so, if you kind of zoom out and ignore what's happened over the last 2 weeks, which is an intelligence failure, and really what happened in Afghanistan over the last 2 weeks is just, it was a tactical issue. And I mean, obviously that sounds callous. People have died, but people have been dying in Afghanistan for 20 years, so including American soldiers. So, this is now just headline risk. The issue here is that the U.S. was always going to withdraw from Afghanistan. The only question was how it was going to do that, and it could have obviously done it much, much better. And that's going to be something that the Biden administration is not going to have to deal with. But fundamentally, I would argue that there's absolutely no risk to the U.S. from withdrawing in Afghanistan. And there are this idea China and India are going to come in and have influence in Afghanistan. Okay, cool story. What does the winner get?
Yeah.
Afghanistan is literally on the way to nowhere.
Yeah. And I guess, a deeper question, in a post-oil world, right, where you're getting this big shift to EV, does the Middle East matter anymore?
Yes, it really does. And the reason it matters, Joe, is because, my highest conviction view, we're 40 minutes into the call, and I'm giving you just now my highest conviction view. My highest conviction view is green tech and anything that has to do with sustainability. And no, not because I think the world is going to warm up and we're all going to be cooked like frogs, although yes, that too. Let's leave that aside. That's been the case for the past 20 years. Nobody has cared. No, Al Gore, Greta Thunberg have been on our case for the last 20 years. Nobody has cared. The difference now is threefold. First and foremost, we have technological breakthroughs. When you have low, interest rates at zero, and when you sink capital into a theme, you're going to get innovation. All right? Like, that's just going to happen. That's how we got shale revolution, because interest rates were at zero for 10 years, and there was geopolitical risk in the Middle East. Why do you think Americans discovered shale? First of all, it's 1940s technology that was refined thanks to low interest rates and a geopolitical risk somewhere else. And boom, we got innovation. So we have technological innovation in the green space. It's serious, it's legitimate, it's not a liberal conspiracy. Like, we're getting real technological innovation. Point one. Point two is there is a populist demand for nominal GDP growth that I was talking about earlier. Like, people want growth, okay? So if you're a politician, what are you going to spend on? Okay, green retrofitting buildings sounds awesome. Let's sink money into this green infrastructure business because it's going to employ plumbers and scaffolders and contractors. Cool. Okay. So there's this requirement for nominal GDP growth. Like, Europe is basically allowing you to spend as much as you want if it's on green stuff. China, as I said earlier, is going to create a green interest rate cut. What? All right, so that's the second point. The third point, which I think is most important, is China and America don't like each other. Okay, what does that have to do with green technology and oil and all that stuff? Well, it has to do with a lot because of this chart right here. And it's that as America is geopolitically deleveraging out of the Middle East, guess who's leveraging up? China. This chart on the left shows you crude oil imports by China from different places, and the purple line is the Middle East. So here's the U.S. invasion in Iraq and Afghanistan in the early 2000s. Middle East wasn't that important. In fact, North Africa and Middle East were pretty much the supplied China with the same amount. As Chinese economy has grown, and as America has deleveraged from the Middle East, specifically as the shale revolution has allowed the U.S. to stop importing from the Middle East, China has re-leveraged higher. Now, that's a big vulnerability to China, geopolitically. This is a huge, huge vulnerability for China. And they can resolve it two ways. They can build a deep blue water navy to compete with America in order to secure the Straits of Hormuz for themselves. Because let me just be very blunt here. Today, this barrel of oil from the Middle East is secured by the U.S. Navy. The U.S. Navy is securing the passage of Chinese oil through the Straits of Hormuz. That's literally, American taxpayers are making sure that China gets its energy so it can invade Taiwan. What? Okay, so there's two things that can happen. China can either build a navy to secure the Straits of Hormuz for itself, which is going to cost a gargantuan, an obscene amount of money and time, or they can just plow every single resource they have into EV, green stuff, solar stocks, which is why those are blowing out. So there's a geopolitical component to the green revolution as well. China's doing this for real. Now, what does that mean? Does Middle East still matter? Well, yes, because Joe, over the next 2 to 3 years, there's no way we can adopt EVs fast enough for them to matter. In other words, I think this is the biggest trend in the world for the next decade, the green stuff, sustainability tech. We're starting a fund, by the way, on this thesis. We're, again, putting our money where our mouth is. So let's leave that aside. I think it's awesome. But in the next 2 to 3 years, you can't actually ramp up demand for, you're not going to lose enough demand for oil, but you can instantaneously destroy capex in the energy sector. And so I actually think that for the next 2 to 3 years, oil prices are going higher. And so I do think that and they're going higher specifically because of this thesis. Because while demand for energy and oil are going to stay relatively the same, the capex necessary to meet that demand is not going to show up. It's going to be dried up. No one's going to invest in a 20-year project off the coast of Brazil, drilling 3,000 meters underwater. No one's going to invest in that in this climate where we all know where we're headed for the next 10 years. So there's this pocket of oil prices going higher where it does matter what happens in the Middle East. And specifically, it matters whether America continues to deleverage geopolitically. And that means negotiations with Iran are the next big thing. If Biden rushed out of Afghanistan, he's probably going to rush into a deal with Iran as well. And so that's something to watch right now. That's the next big issue.
So you think if just focused on Iran and oil supply, the risk for oil supply would be to the upside because you think a deal will be quicker than people expect?
Yes, I think the deal will be quicker, but I don't know how much Iran can bring online.
Okay.
So right now, their export numbers show they're exporting like 300,000 barrels. But there's this like 500,000 barrels that's probably going to China that's just not recorded.
Right.
So I think that Iran is probably exporting somewhere 800,000 to 1 million. So when the deal happens, they're going to just say, oh, here's 500,000. And then China's going to say, like, we're not going to import this 500,000 from Oman and Malaysia that magically showed up.
Right.
You know what I mean? So, like, how much supply is Iran going to bring online after the deal?
Okay.
I'm not sure. I don't think it's going to be enough to satisfy the demand that is recovering with the economy. So, net, I think oil prices are not going to drop significantly below $60 over the next 12 to 24 months. And I think the upside is much higher risk.
Okay, and another question coming in, of course, our clients are predominantly Canadian, is about Canadian election. And, the surprise is that the Conservatives and Liberals on the national polls are neck and neck. So any kind of thoughts in terms of potential outcome of the election, winner, majority, minority, coalition, and what the implications of that are?
I'm not sure that, it's very difficult to handicap elections like Canada. And the reason for that is because of the first past the post kind of system that it has,
Sure.
plus the parliamentary, so basically you have single districts and you have parties. It's very difficult to see how that happens, how it articulates itself. United Kingdom is very similar as well, very difficult to forecast which way things go. I think the fact that, conservatives have gone up in the polls bodes pretty poorly for Trudeau. I think he made a mistake. And really every early election is usually a mistake by the incumbent. It's always a risk. People don't, this is something that I would have, if someone asked me, I would have said, look, nobody wants to go to the polls early. Usually you have this, an air of ennui if you're being asked, dragged to the polls. Plus, there is a surge, and that looks bad on Trudeau as well. And I think that, he's building his campaign on this idea that Canada has handled COVID well.
Right.
But then why are you doing an election in kind of the middle of the Delta wave, which again, Canada has handled much better than most other countries, but there is still technically a Delta wave going on. So
Sure.
I would say that he made I think the Liberals made a mistake. I think there is a chance of a conservative government or a minority government or some sort of a coalition. The only question, and obviously we know where this is going to be decided. This is going to be decided in Quebec, and this is going to be decided also in British Columbia. I think those are the two provinces that are going to be really, really important for the Liberals to try to win some seats in. But all that said, I don't think it really matters that much for policy. I think ultimately Canadian markets are at the whim of global forces. And that means total social financing in China and the US dollar are more important to what happens to Canadian markets than who's in power in Ottawa. And I say that as a proud Canadian. By the way, I say that as a proud Canadian. The last time I was in Canada, I flew from Santa Monica to give my oath to the Queen. That was the last time I was able to enter Canada. It was the end of 2019. I've actually lived in Canada longer than any other country. So, and most of it in Quebec. So, I follow Canadian politics out of interest more than out of, professional reasons. And that's because ultimately Canadian assets don't respond to who's in power.
Right. you're arguing they're more globally focused, unless things are extremely dire, which they don't appear to be, at this moment. Something else, our clients are interested in that is an area of expertise, and I'll tack on something that we're interested from an investment perspective, is climate change legislation going forward, I guess, particularly in the US or EU or maybe even China. What do you see kind of incrementally from here? And just a quick point on trading of carbon credits, which I've heard is a very interesting strategy because it's not correlated to anything else. And at least at this point, particularly in California, you can get excess returns. But I really know very, very little. So kind of climate change legislation going forward, and a quick point on carbon credits. Is it a good investment? And if we can, let's try and limit to, let's say, 3 minutes.
So carbon credit, I think, so first of all, 6-8 months ago, a lot of the sophisticated macro hedge funds that we track, that we've seeded, so a number of them, start investing in carbon credits in both Europe and California. So yes, some of the biggest names that you can think of are playing these markets and are very, very enthusiastic about them. My concern though, is that they're rising in prices. And that's not what policymakers really want. They don't want the prices of these carbon credits to go so far up that industry is stifled. So you have to understand that the supply of these credits is controlled by the government, and they can flood supply and drop prices whenever they want. So that's a huge risk now to getting into these markets as they hit some record highs. The other issue is that, look, my point, the reason it's my highest conviction view to invest in green technology is because this game is over. I don't care if Attila the Hun becomes the Prime Minister of Canada. I don't care if Genghis Khan becomes the Prime Minister of Canada. Like, Canada's not going to reverse climate policy. Like, forget it. Like, if you're a climate skeptic and you're on this call, be very, very careful. What did I say at the beginning? This isn't about what Greta Thunberg or Al Gore want you to do. This is not about moral, normative, let's save our children from climate change anymore argument. No, 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 no. It's based on 3 hard facts. 1, green technology works. Just don't argue. Just trust me. 2, policymakers want to generate nominal GDP growth. They need a reason to spend money. Green stuff seems like a good idea. You may not like it, but believe me, there is more policy, fiscal space expanding on this than ever in human history on any other endeavor. They're just plowing money into this in China, Europe, and the US. And finally, there's a geopolitical component. I don't care if, like I said, Donald Trump, Genghis Khan, Attila the Hun can become presidents of US or Prime Minister of China, of Canada, doesn't matter. Because when China starts plowing money and effort into achieving EVs and batteries, America's going to follow. America's not going to sit back and say like, let's stick with the internal combustion engine. Like, what? That would be like saying in the early 20th century, like, this internal combustion stuff, the Germans can have it. We're going to stay in a horse and buggy because we're really good in producing buggies. It's not going to happen. You've got to take your ideology out of this argument. And I say that because, as you said, a lot of your clients are Canadians. I assume some are climate skeptics, maybe somewhere in Alberta sitting there stewing that everyone's become a green liberal environmentalist. You have to take ideology out of it. This is the biggest trend that we have right now. Is it stupid? Yeah, it might be. We are in an ice age, by the way. Like, it might be stupid. That's fine. It's just, I'm not here to argue ideological issues. I'm here to tell you where politics is going. And there's no way that like some random conservative Prime Minister of Canada is going to stand in the way of a massive wave of global legislation. Like, this is the biggest policy issue for the next decade. No one's going to do a 180. We're going to keep plowing massive amount of tax dollars into these technologies, which means that they will innovate and there'll be new stuff. Now, the good news is you can't bottom fish energy assets. As I said, I'm bullish in oil because of this thesis, ironically. And particularly Canadian oil sands have become a lot more environmentally sustainable, actually. And Alberta has massive amount of infrastructure that can be used in the production of hydrogen, as an example. So there are some plays here, especially in Alberta, that I think will actually benefit from this. And when I go to Texas and I give this view, by the way, and I do this quite often, a lot of Texans grumble and they're like, pink commie liberals, like in their green stuff. And then they're like, oh shit, you know what? Our pipeline infrastructure is actually going to benefit because we're going to flare all this methane, we're going to produce hydrogen and then ship it to the, oh, okay, cool. I like this story. So, and by the way, they don't need me to tell them this. They're telling me what they're doing. And a lot of families who have built their wealth through fossil fuels in Texas are playing this theme massively. Why? Because they're not letting ideology impact their wealth and impact their returns.
So who do you think is going to collect the rent in terms of that theme? So if there's a lot of innovation and so on, you don't necessarily know who the winner is, but maybe in some areas there's either going to be a monopoly or oligopoly, or there's some people with technology that others just won't be able to catch up, or there's infrastructure. Like who's going to be the one making the excess profits?
I like pipelines. Pipelines are going to be required for a lot of the carbon sequestration technology. So,
Okay.
So like pipelines are a really good investment, and that's why I mentioned Alberta has the infrastructure for this. I also think that this isn't SaaS. This isn't software. So don't worry too much about investing in monopolies. You're really investing in TAM in this world.
Okay.
So like, for example, like Beyond Meat, which was a fantastic investment if you had gotten in early. Beyond Meat, can you have a competitor can Beyond Meat have a monopoly? Of course not. It'd be ridiculous to have it. But the TAM is like people who desire protein. Oh, the human population of the earth is your TAM. So I think that that's something that we should stop worrying about the way we invest in software. I don't think it's going to be the same here. That's the difference between software, atoms, and bits. Like we're investing in atoms here. The TAM is the whole world. And the technological innovation that's coming through this thesis is going to really be broad-based. So will there be a monopoly of battery producers? No, I don't think so. Will there be of EVs? No. Of the infrastructure? Not really. But I think that other than pipelines, I really can't think of anyone else that will have a monopoly. So you should really prepare yourself for a different type of investing, which is to focus on TAM.
Okay. And one last question, probably the most difficult question, and we're going to try and keep you again to 2 or 3 minutes. If our listeners look back 10 years from now, what are they going to say? This is the thing that Marko said that nobody else was saying, and he's so right, and this is how I made gobs and gobs and gobs of money.
Oh, that's easy. I need like 10 seconds.
Oh, perfect.
Now, the only thing is I'm not sure that I'm the only one saying it, but it's just energy. It's green stuff. Just green stuff, green tech. I think in 10 years, there's no more NASDAQ. It doesn't exist. There's a green stack. That's it. Here is where, and everyone's talking, solar stocks and all this stuff is in a bubble. Sure, probably, whatever. If you have a long-term horizon, just close your eyes, shut up, and plow your money into this stuff. Especially if you don't like it for ideological reasons. Then you should put all your money in this because you're biased against it, and you're going to be wrong. This is your NASDAQ. This is what it looked like from 1994 to today. This is where we are, I think, with MSCI Alternative Energy Index. Now, that said, the one thing I will say is I do think public markets, when it comes to green stuff, are in a bubble.
Yeah.
And that's because, again, I'm not the only one saying this. Everyone's saying this. Everyone's ESG this, ESG that. Most of that is snake oil. Most of that is fraud. And so you have a lot of demand for this stuff, but not enough supply in the public markets.
Sure.
And that's why we are adopting a strategy of focusing on green innovation, green tech innovation through the private side, which is where I think some of these, like revolutionary companies are going to be. If you're playing this theme in the public markets, you're probably buying MySpace. You're probably not buying Facebook. Facebook of the green revolution is private.
Okay, so that's fantastic. Thank you so much for the very, very insightful talk. I'm sure that our viewers will benefit vastly. I think just to kind of summarize, and you can tell me if I'm wrong on any of these points. Marko's extremely bullish on EV. Maybe it should be your only investment. That wouldn't be our argument. We're into diversification. That also can open up some near-term opportunities, let's say over the next couple of years, in energy and energy-related assets, which is also quite bullish for the Canadian dollar. And we are, positive on the currency. And the last would be that EM versus the developed markets, looks quite interesting from here due to, relative performance, relative valuation, but the fact that China has started to reflate and will do so additionally. Marko, did I miss anything?
I mean, I would just say that when you talk about green technology, it's much more than EV. And I know you're being just, like kind of brisk, but I would say that there's a whole slew of things that are happening, whether that's hydrogen, carbon sequestration, whether it's software and enterprise solutions to make things more efficient. There's like a really big green technology kind of stream. Think of it like in the 90s when people talk about software. It was like multifaceted. Same here.
Sure.
A lot of things fall under this purview. So I would just modify that. And everything else, I think you're right. Everything else, you put it really well. I mean, one thing we didn't talk about is how this green technology push will help emerging markets because commodities will go higher. That's another thing that you can talk about. I'm willing to share the 58-page chart pack with your clients, so I'll email it to you, Joe, and
Sure.
they can peruse through the charts.
That's fantastic. Thank you so much. And
Thank you.
to our viewers, if you have any follow-up questions, then please feel free to contact Northland Wealth. We'd be more than happy to find answers for you. So thank you and have a wonderful day.
Thank you, Joe. Thank you, Fabian.